This is our Forex blog for April 26, 2013, and these are our currency indexes. So what we do basically is statistically compare every currency to every other one and create a chart of that currency. So you can, at an eyeball's glance, see that the dollar has been trending down. It's underneath its hourly moving average for most of the day. It's more likely to go down than up. This is the point of control the previous day in yellow. This is the point of control, in other words, the price that most traders have positions in the dollar currencies for last week. You can also see that yesterday's point of control fell 42 pips, so it's very likely to go down today. It might have a counter trend move like you saw, but once it breaks this trend line right here, it's very likely to go down. Now, if it can't get back above the point of control and breaks down here, so this is one place to sell, this is another place to sell. Previous day's low gives you lots of information. You can in many cases predict future price movements by using this. You basically want to sell weak currencies versus strong currencies. So let me show you how to use this. Let's get to what you really want to know, how to make money with this. The euro, you can see the daily and weekly trends down. It does find support at yesterday's euro-dollar index. This was the lowest that all the euro pairs went yesterday. It formed a nice double bottom there, broke from below to above the hourly moving average at 3 o'clock. It's likely to work its way up to the next resistance area, which is the previous day's point of control. You can see that the previous day it fell 24 pips, the index. So it is not likely to go above this. This is a potential profit target. But once you find a double bottom right here and it breaks out, you can certainly look to buy it. You would want to buy it against a currency that's weak. The dollar's weak, it's underneath its hourly, but it's kind of heading up right now. You certainly wouldn't want to buy the euro versus the yen, because the yen is strong right now. The daily trend is very strong. The weekly trend, however, is down. The weakest ones on the chart at that time is the Australian. So basically it's a no-brainer. You want to, at 3 o'clock, look for euro-Australian buys. And guess what? This is how you use and anticipate our software. It went up to our upper containment band. A lot of times it works their way up to the 2.0 band. This is usually pretty much where they reverse. So this is your first profit target. This is your second profit target. It didn't make it to the second one. But you can see it went up 10, 20, 30 or so pips, and your risk is very tiny. This is what your risk is. And you never know what you're going to make, but you have to use potential profit targets in deciding whether the likely or potential return justifies the risk. And anytime the potential profit is 1.5 to 2 times or more bigger, you got to pull the trigger. So this was a very high probability trade, and one that's likely to give you maybe 3 to 5 times more profit than what your risk is. You know, with wins of 2 to 5 times bigger than your losses, you don't have to be right even half the time. And as you'll notice, our tools do tend to be accurate, very high percentage. Another tool that will help you is a perfect oscillator. When this hits plus 80, typically markets reverse down. When it hits minus 80, typically they reverse up. Not all the time. You can see, you know, right here it kind of went sideways and then it went up. Right here was the high. This one here failed. This one right here was the high. That one worked. This one right here was the low. That one certainly worked. This was pretty close to the high. That one certainly worked. It works a very high percentage of the time, and especially when you have a trend that's up and you get pullbacks at the minus 80. These are very, very high, even higher than the rest of them, because the trend's up. It pulled back too much, and you can see it went from 50 all the way back to up to 80 during the dead time of a Friday afternoon. Even 20 pips is a nice return in 2 hours during Friday afternoons. All right, so let's go back and look at the currency indexes some more. We have a very weak Australian. Now, we sold that against the euro. What other currency is strong? Well, the Australian found support at the hourly moving average. It couldn't get back underneath it for about 10 hours, and then it broke out earlier in the day. This one was weak. The CAD was weak. However, the longer term trend of that one's up. Obviously, one of the better trades earlier in the day was selling the euro yen or selling the Australian yen. So let's take a look at the Australian yen. Basically, we want to look for sells in this, and there's 2 ways that we look for entries. One is kind of a pullback trade up, finds resistance at the hourly, can't really get above the hourly right here, breaks down. That's a good trade. This is a somewhat okay trade. This one's better for many reasons. One, anytime you get a 2-wave pullback as a counter trend trade, and it also happens to be right near a fib target. Excellent place to get in. The second trade right here, the perfect oscillator is above the Bollinger Band on the perfect oscillator, and typically when it comes back into the range right here, it's the perfect time to get in, which is right here. I typically will wait for a price to prove it to me and go underneath the previous bar's low, and you would get short with your stop right here. This is what your risk is. Now, a lot of times markets will return to the previous low, so this is your estimated profit target. You know, the containment band right there. Is this 1.5 to 2 times bigger than that? Heck yeah, it is. So it's likely, or has the potential at least, to give you 4 times bigger profit than your risk. Now, typically what I'll do is if it goes down a little bit, comes back again, you know, I'm just kind of trailing my stop above the trend line over those bars high, I would be out somewhere right here. And because it didn't get enough of a pullback, this isn't enough of a pullback for me to get back in the trade, but the fact that it sat for about an hour and a half, couldn't go up, when it breaks down right here, you got to go short again. You draw your fibs off of this, and you have profit targets of here and here. I'll draw that on there right now. You can kind of eyeball where the fib targets are once you do enough of them, and I was pretty accurate on that estimation. So this is went right to the fib target. I would have probably got out of half my trade here, and usually the second half here, but it did break that level, so kind of somewhere around here is probably where I would have got out of my second trade. Lower containment band, notice, contained price, as it normally does. Watch, let's zoom out. How many times does this white band get broken? Very rarely, and usually when it does, price will go through it. Notice, you know, very close to it here. Nailed it to, almost to the pip here. Containment bands are excellent tools for knowing when to get out of your trend trades, and if you're inclined, look for counter trend trades. And there's so many different ways to and types of trades you can take with this. Anytime you have a sideways rectangle pattern and you get a breakdown, you know, obviously there was a trade here that would have lost, and then you went short again. The New Zealand here at 10, very high probability. Currencies that go from below to above the hourly, and especially retest it, can't get back underneath it, very high probability here at 11. Selling the New Zealand CAD at around 1040, very high probability, probably 80% trade, because both individual currencies have patterns. New Zealand CAD 840. Let's take a look at this on the chart. Maybe it was after 840. Hold on. Oh yeah, it was 1030. Sorry. So let's go back to 1030. This one at 1030, it had a false breakout above the hourly moving average. You have a 1, 2, 3 pattern right here. It also kind of broke this little mini wedge, and at 1030, I mean, if you were watching and trading this chart by itself, you would go short when it broke the hourly right here after having a reversal pattern. There's not. I like to see pullbacks that kind of come back up and retest it. Those are some of the easiest and highest probability trades. They also give you the biggest potential profit, because this is what your potential profit is. Selling the lows, you know, right here is a much worse trade. It's still likely to give you 20 pips while you're risking maybe 10, but it's not one of those trades that you would, you know, really jump on super high. And this one was so weak that it did actually break, you know, the 2.0 band, and it went down again. But usually, you know, when it goes underneath there, you're going to get some kind of a bounce. So you got to watch it like a hawk when it's underneath the lower bands. Let's find one more example today, being a Friday and being late. You know, when you see a strong currency all day like the pound, the daily trend's up, the weekly trend's up. When it pulls back to the hourly here and it kind of breaks out this little wedge pattern, I don't like to take trades on Friday at 12, but it's pretty likely to kind of inch its way up after 12. At 12, which one's the weakest? It's probably the New Zealand. So we'll look at buying the pound New Zealand after 12. And you can see that it, you know, made a couple more waves up. At 12, it basically broke out and made new highs. And these are like 25 pips, so that's pretty nice profit. Just buy it and get out. Buy the pullback, get out. This is kind of not much of a pullback. You buy it right here and get out, and look where it stopped, right at the white band. That's what happens more often than not. So you have, 1, 2, 3 trades, all 20, 25 pips with super tiny 10 to 12 pip risks. The wins are 2 times bigger than the loss, or the estimated risk, where you put your stop, and that's it. That's all you got to worry about. Is this trade 50 to 80% likely to work? Yes. Is the likely potential profit target 1.5 to 2 times or more away? The farther away it is, I'm willing to take a trade that's 30 or 40% likely to work if it has a 4 to 5 times win-loss. I won't take a trade that's 90% likely to work if it's only going to give me 10 pips and I'm risking 10 pips. So that's the way you should think.